Hey there, and welcome to The Explainer. Today, we're unpacking something that completely reframes how we build wealth. It's kind of fascinating. People often throw money at the stock market hoping to hit the jackpot, completely missing the fact that the sequence of our actions actually matters way more than the specific investments we pick. The source material we're looking at today outlines an exact mathematical order for investing. It's a sequence that can literally save you tens of thousands of dollars and dramatically accelerate your path to financial independence.
Okay, let's dive into this. I absolutely love this quote because it brilliantly illustrates the core problem. It is so common for people to ask if they should buy individual stocks, or the latest trendy ETF, or if they should jump into crypto. But they're asking these questions while ignoring huge, gaping holes in their financial foundations. Trying to build wealth while carrying terrible debt or having zero savings, it's like trying to fill a bucket that has massive holes in the bottom, and then wondering why you're not making any progress. You just can't start buying the flashy stuff when the basics are completely broken.
So just how broken are these basics? The data is actually shocking. According to recent numbers, 1 in 3 Americans doesn't even have an emergency fund. And the median amount that Americans have saved for emergencies, a whopping $500. Think about that for a second. That is literally less than most people's monthly car payment. And, alarmingly, that number is actually down from $600 just last year. This is the reality. It's like trying to sprint before you even know how to tie your shoes.
To fix this, we need a roadmap. Here's the exact chronological blueprint we're going to follow to build out our financial house. First, the costly investment illusion. Second, fixing the financial foundation. Third, the free money loophole. Fourth, the tax optimization zone. And finally, the taxable Wild West. By the end of this explainer, you'll know exactly how to level up your finances step by step.
Let's start with Phase 1, the costly investment illusion. Imagine you're building a house. You wouldn't start by picking out fancy light fixtures and beautiful granite countertops if the foundation was cracked and the roof was leaking, right? Yet that's exactly what so many of us do with our finances. It's super easy to skip the boring groundwork because, well, it's just not as exciting as trying to time the market.
And here's the stark reality of that illusion. People get all excited about trendy stocks while they're carrying credit card debt with average interest rates over 22%. Look, credit card debt is essentially financial cancer. Every single month, a 22% interest rate is delayed. That debt grows faster than almost any investment you could reasonably expect to make. Trying to invest while carrying high-interest debt is mathematically impossible to out-earn. It's exactly like trying to run a marathon with a backpack full of rocks.
Which brings us right to Phase 2, fixing the financial foundation. This is the unsexy, foundational groundwork you have to establish before investing a single dollar anywhere else. Without these pieces in place, everything else is essentially building on quicksand.
Step 1 of the foundation is establishing an emergency fund. I know, it sounds boring, but an emergency fund isn't just about having cash for unexpected expenses. It's about creating a psychological safety net. When life inevitably throws a curveball, like a broken-down car or a surprise medical bill, this net prevents you from making terrible financial decisions. It means you don't have to sell your investments at the worst possible time or rack up more high-interest debt. Now, the traditional advice of save 3 to 6 months is kind of broad and overwhelming, so break it down. Start by saving your first $1,000 as quickly as humanly possible. Once you hit that milestone, work toward 1 full month of living expenses and keep building until you hit 3 months.
And if you're wondering if that really makes a difference, the data brilliantly proves it does. Recent research from Vanguard found that people with at least $2,000 in emergency savings had financial well-being scores that were 21% higher than those without any emergency fund. That was the single largest boost linked to any financial factor they measured. $2,000 isn't life-changing wealth, but the psychological impact of having that buffer is absolutely enormous.
Once that emergency fund is in place, your next critical foundational step is eliminating high-interest debt. Basically, anything charging over about 8% annually. The absolute most efficient way to do this is the debt avalanche method. You list out your debts, pay the minimums on everything, and throw every extra dollar you have at the debt with the highest interest rate. Now, some people prefer the debt snowball method, where you pay the smallest balances first for a psychological win, but since we're looking for the optimal sequence here, the avalanche method is mathematically superior because it saves you the absolute most money.
So, the crucial point is exactly how powerful paying off this debt really is. Let's say you have $5,000 in credit card debt at 22% interest. If you only make minimum payments, you're going to pay nearly $2,800 just in interest over 5 years. That's your money working against you. Every dollar you use to pay down that debt is essentially earning a guaranteed 22% return. Think about that. That guaranteed return completely beats Warren Buffett's long-term average in the stock market. Killing high-interest debt is absolutely the best investment you can make right now.
All right, let's move on to phase 3, where things get really fascinating. The free money loophole. Now, I know I just said to eliminate all high-interest debt before investing, but there is one major, mathematical exception to this rule. It's so important it literally unlocks a cheat code for building wealth. If your employer offers a matching contribution to your retirement plan, it's mathematically optimal to contribute enough to get the full match. Yes, even before you finish paying off high-interest debt. I know that might sound counterintuitive, but just look at the math. An employer match is essentially a guaranteed 100% return on your investment up to their limit. For example, if they match 50 cents on the dollar up to 6% of your salary, and you're earning $50,000, contributing $3,000 gets you a $1,500 match. That is a 50% immediate return, plus whatever the market grows. It is literally free money lying on the ground. The only caveat? Just watch out for your company's vesting schedule if you're planning on leaving the job soon. But otherwise, capture the match and then redirect your extra cash back to the debt avalanche.
Once your foundation is locked down, emergency fund built, high-interest debt gone, employer match captured, we enter phase 4, the tax optimization zone. It is incredibly easy to mess this up by getting distracted and skipping straight to taxable accounts. Instead, we want to build an ascending ladder of wealth by maximizing tax-advantaged accounts before the IRS can take their cut.
So, after getting that 401k match, the immediate next step is actually maximizing an individual retirement account, or IRA. For 2025, the limit is $7,000, or $8,000 if you're 50 or older, which is basically a nice little participation trophy for getting older. But why the IRA next? Because corporate 401k plans are notorious for offering limited menus of really expensive mutual funds. Those 1% to 2% management fees, they can eat your returns like termites in a wooden house. An IRA gives you total control to invest in low-cost index funds in ETFs that charge just a few basis points. Over decades, that saves you tens of thousands of dollars. Now, deciding between a traditional and a Roth IRA basically boils down to this. Do you want to pay taxes now or later? Traditional accounts let you deduct contributions from your current income, but you pay taxes when you withdraw in retirement. Roth accounts require you to pay taxes up front, but then all your withdrawals in retirement are completely tax-free. Look, predicting future tax brackets is about as reliable as predicting the weather 3 months from now. But generally speaking, young earners in their lowest earning years should lean toward Roth. Higher earners hitting their peak income might benefit more from traditional accounts to lower their current tax burden. Or you could always split contributions to create some great tax diversification.
Next up in the tax optimization zone is what might be the single most underutilized investment vehicle in America, the Health Savings Account, or HSA. If you have access to a high-deductible health plan, the HSA is an absolute Swiss Army knife. It offers an incredible triple tax advantage. You get a tax deduction on contributions, the money grows tax-free, and withdrawals for qualified medical expenses are completely tax-free. It's genuinely amazing. It's the only account that gives you tax benefits on the way in, while the money grows, and on the way out. The optimal strategy here? Pay your current medical expenses out of pocket if you can, keep the receipts, and let that HSA money stay invested. You can actually reimburse yourself tax-free 20 years from now. The math on this is absolutely stunning. For 2025, you can contribute up to $4,300 as an individual or $8,550 for a family. If you max out an HSA for 30 years and achieve a 7% annual return, it could yield over $400,000 in completely tax-free money for medical expenses. Considering the average couple retiring today is going to spend over $300,000 on healthcare throughout retirement, an HSA essentially makes those massive costs completely disappear from your retirement budget.
Once the HSA is maximized, the strategy returns back to the 401k to max it out well beyond the employer match. The 2025 limit is $23,500 for most people, or $31,000 for those 50 or older. By completing this step, between your IRA, HSA, and 401k, you are sheltering over $35,000 annually from current taxation. Your money just gets to compound without any tax drag whatsoever. To put that into perspective, since the average American only saves about 6% of their income, reaching a point where you can max out these accounts mathematically places you in the top 5% of savers in the country.
Finally, we reach phase 5, the taxable Wild West. This is the very final step, and ironically, it's exactly where most novices incorrectly start their investing journey. There's a very solid mathematical reason this belongs at the end.
Now, what's really interesting about this slide is the staggering gap you see here. Let's say you invest $10,000 annually for 30 years at a 7% return. In a tax-advantaged account, you end up with about $944,000. But in a taxable account where you're paying taxes on dividends and capital gains along the way, you might end up closer to $700,000. That is nearly a $250,000 difference caused purely by the environment you kept the money in.
That $250,000 loss is what we call tax drag. Because taxable accounts have no contribution limits or withdrawal restrictions, it's really easy to assume they're the smarter, more flexible choice. But remember, every dividend gets taxed. Every time a sale results in a gain, the IRS takes their cut. Investing purely in a taxable account before utilizing your tax-advantaged options is literally like running a race while someone keeps throwing sand in your shoes. You're going to finish, but it's going to be a whole lot harder than it needs to be.
However, once your boring foundation is set and those tax optimization zones are maxed out, taxable accounts become incredibly valuable. They offer the ultimate flexibility for specific high-level financial goals. Need money for a house down payment in 5 years? Perfect. Want to retire early and need bridge funding before you can access your retirement accounts? This is exactly where it comes from. Planning to leave money to your kids? Taxable accounts get a step-up in basis upon death, which can eliminate capital gains taxes entirely. They are absolutely amazing tools, but for sure only when used in the correct order.
So as we wrap up this explainer, the biggest takeaway is to take a hard look at our own portfolios and ask, are we building wealth sequentially, or are we accidentally just feeding the tax code and credit card companies? Emergency fund, high-interest debt, employer match, IRA, HSA, 401k, and finally, taxable accounts. By following this sequence and doing the boring stuff,